Welcome to the What to Watch video update. This is the last weekend video that I do where I put together a bunch of charts and I arrange them into three categories. Those that are positive, those that are negative, and just areas that we want to keep an eye on during the week. Now we're looking pretty solid with the S&P 500, but it seems to be slowing down. We're still exuberant when it comes to sentiment. All of the sideways action that has taken place over the last few months has occurred above the 20 period moving average. That's positive. But we're seeing a little bit of vulnerability. We're also potentially coming into a weaker time of the year. Volume is below average. It's the summer months. And over the last couple of years, we've seen a pretty significant decline starting about the middle or so of July and either going into the end of October or going not quite as long. We're just watching to see if something like that will develop this time. There are a few cracks under the surface right now, and I'll go through those in this particular video. So the question we're asking this week, will the S&P 500 keep climbing? And this is being prepared for Monday, July 21st. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. First, we look at the positive side, and most of the charts that you see here will be on the positive side of things. But as always, I like to look through all these charts and potentially pick out some negative things. Here is the intraday chart. We did have an up week overall, so that's why this is on the positive side. Now, we took a bit of a turn down on Wednesday. This is when some news came out that President Trump may fire Jerome Powell. He can't do that, but it still hit the wires anyway. And then a few minutes later said, well, that's highly unlikely. We came all the way down to this level, which is S2, and then we were able to bounce up off of that and see a pretty good move going up into the close. And that seemed to carry over into Thursday. Then we had some reports come out that had to do with housing on Friday that initially looked positive, but then when you look under the surface, they weren't as positive after all. And that produced a gap higher open. We actually set an intraday all-time high, but that's where we set the high, was right at the open, and then drifted down going into the rest of the week to finish out slightly positive on a percentage basis. All right, here's the daily chart. Still looking pretty constructive overall. The red dashed line, that's the previous high that was set back in February. Just kind of keeping it on here as a reference point. We are in an uptrend. We're potentially coming up to this dashed line that you can see here. That's an overhead resistance level. It's a pivot point that's been on the chart for some time. The reason why it's just a dashed line is we already have the pivot points for August that are calculated on this chart. That's the neat thing about pivot points, is they're on the chart before we even get there based on time. And these are things that the market really pays attention to as either support or resistance levels. One thing that is not a surprise but still a little bit frustrating is we continue to be below average with volume. Then we are looking pretty exuberant as far as sentiment. You can see how instead of just coming up to this level and then dropping down from it, we're just kind of hanging around the 75 level. That's a pretty high reading. And this is when we start to entertain the idea of using this as a contrarian indicator. When it's going up or down, we tend to follow that until it gets to an extreme reading. Well, we've been extreme here, just like we were extreme negative for a lot of March going into April. We just camped down at these really low levels before we finally were able to come up out of that. Well, we could still stay up here for a while, but in the meantime, we're looking at this more as a contrarian indicator now rather than a directional indicator that we look at as being positive currently. Okay, now when we look at our growth to value ratios, we're looking pretty good there, and that's what we want in a more positive environment. Now, if we do start to decline, right now it looks like it would be more normal, anywhere 2, 3, 4, 5, 10% even. We've seen that before, and we still were able to bounce up out of that. Now, if we do start going down, we'll evaluate things. I do videos every day, and we'll just kind of see, okay, are things switching back more negative? For right now, we're looking more positive. We see the blue line above the red line. This is an intraday chart of growth versus value. The important takeaway is that they're both pretty much going up. We've leveled off here, but we still see the blue line above the red line, and that is more positive intraday for the S&P. Also, an intraday growth to value ratio for the S&P. We really came down on July 1st. That's when a lot of value was bought. Value was up about 1% that day. Growth was down about 1%. So this ratio really took a hit. But ever since then, we've been coming back, and this is still looking more positive overall. And that's what we want in a good, solid environment. Then we break it down. We look at small cap growth to value, even though the indexes have just been chopping around and they're really underperforming with the small caps and mid caps. The growth to value ratio is still hanging in there and looking positive. The same thing here with mid cap growth to value and S&P growth to value, setting a new high here with this growth to value ratio here. That's positive. We want this to go up if we're more positive. Then we look at discretionary, which has been improving and starting to see an uptrend here, or staples, which are more defensive. That's what the market gets into when they're concerned about things going down. That's been chopping along sideways. So for the most part, the equal weight discretionary to staples ratio has been going up. We're also looking good here with the growth to value ratio between these two ETFs. And then we look at some other approaches to growth versus value here, the Qs to S&P. A little bit concerned here. We're still coming up to a declining moving average when we look at discretionary to the S&P. This can get above, and we can see the moving average start to go up. That would be more positive. But we're looking quite healthy when we compare large cap growth to large cap value with this ratio. So we continue to look good at the index level with the growth versus value ratios, with the large caps, the mid caps, and even the small caps. We're just seeing the mid caps and small caps underperform. Large cap growth, just setting recent all-time highs here above all the moving averages, and the moving averages are going up. That's positive. This ratio going down is positive. This is value to tech, which is the big growth area. And so that's still looking positive for the market. We're still below 20 with the VIX. That's when we see positive annualized returns. So that's looking good there. And we're getting a reading here with the skew index. Now, we did have options expiration on Friday, and that might have skewed the skew index a little bit here. Maybe some extra calls, extra puts. When we get up into this red area and then spike and start to come down, that means the market's expecting some kind of a big move. We're just not sure if it's an upward move or a downward move at that time. We have to use other charts to give us some more context. But this is giving us one of those extreme readings yet again. And we're looking positive here with the risk on to risk off ratio. That continues to go up. And the high beta to low beta ratio is going up. That's positive for the market. And we're not setting a new all-time high with the advanced decline line based on price, but we are based on volume. And when volume leads price, that tends to be more positive. So the advanced decline line here is still looking pretty solid for the S&P. And even though we're starting to break out and show some new highs, we're not really seeing a contraction, or we're not seeing a growth in the new lows. We're still looking negative with our 5-day chart. We're trying to turn back up here, but our 10-day is starting to level off. Then we look at our smart money indicators. We're looking positive here. In the bigger picture, we see the indicator above an advancing moving average. That's positive. And we're just barely coming back above the moving average here with the boom indicator. This measures more of the short-term movement between the indicator and the moving average. That's what it's supposed to do. Really, all this is a modified MACD, which with a much shorter time frame. And another smart money indicator is the chicken money flow. The red line's going up, the histogram's going up. That's positive. But you'll notice when we get the smart money indicator number 3, it's going to be on the negative side. And then the vortex, we were getting a little concerned here as the green line was coming down and the red line was coming up, but this is improving with the green line above the red line. That's positive. What's concerning is when we look at the weekly vortex, we are really extreme here. Now, we could go higher than we did. We did right at the beginning of 2024 here, and that didn't necessarily mean a reversal. We just want to keep an eye on this, that it's positive, but extreme positive, while at the same time, the red line is getting more extreme negative. And the short-term trend still looking positive, but starting to flatten out here. It's still above its moving average. That shows that it's a strengthening trend. The green line is above the red line, so that is positive. Then we switch over to the intermediate term, still going up above the moving average with the green line above the red line. Then we look at a weekly trend here where this is weakening now. This had been negative as we were really coming down in March and into April, and it's taken a while for this to turn back over. We are positive with the green line above the red line, but this is still a weakening trend. Then we look at the condition of the short-term trend based on 20 periods, and I use really fast moving averages to do that. We're still going up with the green line and the blue line, even though price is a little bit below that. It's slowing down just a little bit, but the short-term trend is still positive. Then we look at the intermediate term trend based on 50 periods. The red line and the blue line are going up, even though we're a little bit below the red line. As long as these lines continue to go up, the intermediate term trend is still looking pretty solid. Then we look at all the different moving averages, both simple and exponential versions, and we're above all of the moving averages here. And all of the lines are going up, so that's also positive. But we're kind of far away. We're not really too far away from the 20 period moving average, but we're far away from the 50 period moving average. The boom indicator measures the price versus the moving average. And when we get too far away, this acts like an oscillator and price has a tendency to come back. But we've been overextended now, both with the 20 and 50 period for quite some time. We're still looking positive and we're above zero here with the 200 period moving average steady. And then some short-term and even somewhat intermediate-term trend analysis here. The short-term trend is a 10-period simple moving average. We're above that, and the green line is still going up, even though it's leveling off a little bit. And then the green line's above the orange line, and the orange line is above the blue line, and all the lines are going up. So short and intermediate term, using this bow tie approach, that is still looking positive. And we're positive here with the Landry light. What's a concern is that according to the Landry light indicator, when we get above this dashed line, that means this has gone on for a long time. And so now we can adjust these lines, and there's nothing magical about that. We got down here when we were really headed down, we hit about this minus 40 level, and then we finally switched to an uptrend. So this is looking overextended based on this chart. Okay, then proper order. This is another trend system where the longer we're in the uptrend, the more these lines continue to add along and just make a longer looking line there. But that's positive. And we spent a lot of the last week being negative with the Swanland trading oscillator. After Friday, it's actually starting to turn up based on price and turning up slightly here based on volume. So it had been negative. Now it's switching over and looking more positive. And we're positive with the daily chart of the parabolic SCR. We had something very interesting happen this week. We had enough of a down move to put a dot on top. That's when this switch is negative. But that only lasted for one day. We were able to set enough of a new high here to generate the dots underneath. Usually these dots stay either above or below for a while. It's kind of rare to see it for just one day. Here we had a 3-day one. That's even more rare too, but a 1 day is really quite rare. But this is the daily chart, and it's still positive. We're also still positive with the weekly chart of the parabolic SAR. Momentum, this actually should be on the negative side. So I'm going to skip this because I copied this chart in the wrong place here. We are positive with those stocks above their 20-period moving averages. We're above 50, even though we're ticking down a little bit. Not looking really strong right now as the market's been going sideways with a slight upward bias here. So we're seeing a little bit of a negative divergence. We're still going up based on price, where this indicator is starting to go down more than up. And we look at those stocks above their 50-period moving average. This is still positive, slowing down a little bit. It said it's high right at the beginning of July, and we've still been going up as we're getting lower readings here. Bit of a negative divergence there, but still positive. And we're still positive with the 100-period moving average study and the 200-period moving average study. So those are still looking pretty good. In the short and intermediate term, a little bit of a concern with some negative divergences. And we're still going up for the most part here with the S&P to utilities ratio. This means that the S&P is outperforming utilities, and that's positive. And we're still going down when we look at staples to S&P. This means that the staples are underperforming the S&P, and staples tend to be more defensive. And then when we look at the weekly special K, this is a very long-term oscillator. We continue to be above the moving average. That's positive. It's a little bit negative in that we're seeing the red line, the moving average, starting to drift down, but it's still positive in the bigger picture context. Then we look at a weekly chart of the S&P. Still looking good here as far as our chart formations. Now, if we do go up, we do have an R1 overhead resistance level here at about 64.68. So that's still a few hundred points away, 150 points or so away from where we're at right now. But we'll be watching that. This could end up providing overhead resistance if we get to that level. Then we have the Pring bottom fisher. The buy signal is starting to go away, but it's still considered a buy signal when the black line crosses above the red line. And I just show this, but I don't base my decisions around this. I'm not sure really what bottom the Pring bottom fisher found here. This generated in early July, and I mean, we were going sideways. We had a little bit of a downward movement here, but where this indicator shines a little bit brighter is when we've really been screaming down, and then we come up out of that, similar to what we saw in April. And we're looking positive with all of our advanced decline lines with the NYSE common stock, S&P mid caps, and small caps. Came down a bit here with the small caps on Friday, but we're still above advancing moving averages. And we're in an uptrend here with the NASDAQ, hitting around this R1 overhead resistance level. We're just a little bit above it right now, but the NASDAQ is in an uptrend, setting recent all-time highs. And the NASDAQ 100 also a little bit under this R1 pivot point, which could be overhead resistance, but also in an uptrend, setting recent all-time highs there. Small caps still hanging out right about at their 200-day moving average with the S&P 600. And then we look at another small cap index, the Russell 2000. It's a little bit further above its 200-day moving average. The Wilshire, a broad market measure in an uptrend, still just kind of gently going higher right now. And then another broad market measure is the total U.S. stock ETF in an uptrend, setting recent all-time highs, even though it was down slightly on Friday. Financial sector looking pretty good here. Now, the big banks did report, and we saw some selling into those earnings reports, even though they were quite good. But the financial sector is still holding up quite well. Where we're concerned is going back about the beginning or so to middle part of May, the financials have been underperforming the S&P. Now, that's not totally bad because that means the S&P is outperforming the financials. But we're a little bit concerned about this. This ratio is going down, and we actually dropped below the 200-day moving average. We would like it if this ratio would go up. If the financial sector is actually doing better than the S&P, that tends to be more positive. This is just a little bit of a warning sign right now. The FANG index, these are the really big stocks like Facebook or Meta, Apple, Amazon, Netflix, Google, Nvidia. It's kind of drifting sideways right now, not really giving a lot of power to the indexes, but this is still in an uptrend. And then we do some ratios between stocks and bonds. And the first one that I look at is the S&P to 3 to 7 year bonds. Doing really well here, above the rainbow. Now, when we're up in this area, this means the market is anticipating a soft landing, meaning that we won't go into a recession. As we were really coming down here, when everyone was freaking out about the trade wars and tariffs, yeah, we started to be concerned that we might be going into a recession. But since that time, we're back up into this higher area now. I just like to keep an eye on this. And then we look at this using different indexes and different maturities of bonds to see if we're seeing the same basic thing. This is an inverted version of that same chart that we were just looking at. 3 to 7 year bonds are underperforming the S&P, and that's more positive for the S&P. Then we look at a broad market measure with 3 to 7 year bonds, looking pretty good there. The S&P 1500, a broad market measure with short-term bonds, looking pretty good there. The tech sector to 3 to 7 year bonds, looking really solid that way. Then the Qs to 3 to 7 year bonds, that's the NASDAQ 100, looking pretty solid here. The staples are underperforming the tech sector. That's more positive. That means tech is outperforming. And then a long-term chart of the NASDAQ 100, a weekly chart going back to 2009. We're still dealing with this long-term trend line. Now, I drew this on here, and we did get above it before. I'm just wondering if at some point, is this going to offer some kind of resistance? Because right when we got about to this line is when things started to slow down. I mean, we're still setting new all-time highs, but there's not an awful lot of conviction behind price movement lately. Then we look at a ratio between growth, which is NASDAQ 100, and the Dow, which is value. This is still looking really solid with this ratio. The Qs, again, the NASDAQ 100 to small caps, we're moving further above the blue line. That's positive. Semiconductors growth to Dow value, improving. It'd be even more positive if we could get back up to this blue line, but it's really been improving lately. In the Dow Jones Semiconductor Index, setting a new all-time high, even though it was down in Friday's session. The high was set on Thursday, and we're in an uptrend here. And we look at the SMH Semiconductor ETF, coming off of a recent all-time high in an uptrend. That same ETF above the rainbow here, just using closing prices, just coming off of an all-time high. And the semis to tech ratio did come down a little bit in Friday's session, but overall the semis are outperforming tech. And it's more positive for the market when this ratio is going up. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Then we look at the negative side, and there's not a lot of charts here. This is where I meant to put the oscillators. We're starting to roll over in the short and intermediate term. Now, some of this is how these oscillators are calculated. As each day goes by, the more recent prices are used in the calculation, and we've been going sideways a lot here. So these indicators can't help but roll over. But a lot of times this ends up being a self-fulfilling prophecy. Now with the slope oscillator, we are negative since we're below the moving average, but we're above this green line. So it's still giving us an extreme positive reading. The same thing with the TSI, just kind of floating down here, but giving us an extreme reading. Then we switch over to the intermediate term, seeing a little bit of weakness with the MACD, the PMO, and PPO, rolling over a little bit, but also extreme with the tricks, and a little bit short of being extreme positive with the KST. But as the market's really slowed down lately, all of these have really starting to flatten out a little bit. I'm treating them more as negative, mainly because of what's happening in the short and intermediate term. And then another momentum oscillator is the Copic curve. It's actually crossed below its moving average and is now turned negative. And we're a little bit below zero when we look at the advancers decliners oscillator. This looks at a simple moving average over 10 periods. We're dropping below zero. And we've been going sideways to up here. We've actually been coming down here. That's a bit of a negative divergence. And then here's our smart money indicator number 3. It's negative. We got all the way up to this green line, came back down, tried to recover, went back down. We were looking positive, but then this actually went down on Friday, and we're dropping below the moving average. So that's why this is on the negative side. Then this is the daily chart of the special K. Where the weekly chart's still positive, the daily chart continues to be negative. Even though it's trying to improve, it hasn't crossed above the red line yet. Then we look at the S&P McClellan oscillator, slightly below zero, so that's negative. And when the McClellan oscillator is negative, we're going down but flattening out here based on price. We're declining based on volume. This is more short to intermediate term here. This is a primary indicator. That's what I classify it as. And this going down is more negative. Then we look at the NYSE McClellan oscillator, which also continues to be below zero. So we're declining with the summation index based on price and volume for the NYSE. That's more negative as well. And even though we're getting a very high reading with the bullish percent index, we continue to drop and we're below the moving average here. That's why this is negative. We're also declining to slightly flat here with the NYSE bullish percent index and ticking up a little bit, but still it's been declining as we've been trying to hit new highs here with the NASDAQ 100 bullish percent index. Mass index, this is a weekly chart. I'm not seeing anything on the daily side. And we triggered all of the criteria when we came down and crossed below this red dashed line for the second time. Now, what was happening is we were going up to trigger this line going above the blue line. And now we triggered the signal here. And so this is trying to anticipate in the bigger picture that we might have a reversal. Again, I don't rely just on this chart. We're just keeping an eye on this and then looking for other charts to confirm. Then we look at home construction, which is trying to improve here when compared to 3 to 7 year bonds, but we're still really seeing some struggle here. This started to show some weakness in late 2024 before we saw some more weakness in the broader market here. And it's been going sideways and it's trying to go up here, but it's not really turning back to positive yet. And the momentum for the NASDAQ 100, setting an all-time high on Thursday and an intraday all-time high on Friday, and to see this going down below its moving average, we're not seeing much change here. We're just seeing a lot of flatlining with this particular indicator. And then this is longer term. This is the Zohorchak method, where we spent most of 2023 and 2024 at a full-on 10. That's a buy signal. Well, we dropped down to 0. Now we've dropped all the way down to -10. This is a full sell signal now. This is very long term. So we just want to keep that in the back of our mind here. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then these are some areas that we're watching. These are the pivot points for Monday's session. They're updated every day. They're also updated on the YouTube community tab if you want to check those out. Then we want to keep an eye on jobless claims. Now, the initial jobless claims, they've been doing well. We're back into this range and the moving average is going down. That shows employment is holding up. And we're getting a little high, but we're still below 2 million here with the continuing claims. If this starts to go up, that means that, okay, maybe people aren't getting laid off as much, but those people that are getting laid off are being laid off longer because they have continuing claims here. So we want to keep an eye on this one. And we're just right around average, most of the time below average with volume. We were right at average on Friday, even though it was options expiration. And then I'm watching this, not because it's positive or negative, but if we continue to go up, if we see a break to the upside, this dashed line here is at the 10% level. Now, what we saw in 2023, when we got above this 10% level, that's about where we topped out, and then we went into the decline that lasted until October. And then in 2024, we set a high, came back, set an even higher high here. This was about in July. And then this is when we saw about a 10% decline before we bounced up out of that. So this is just something we're watching in case we do go above the 10% level. Want to keep an eye on the 4.5% level with the 10-year bond. We're still below that, and that's helping stocks. And then we look at the relationship between different kinds of bonds to see, okay, is inflation becoming a problem? Here, we're just going sideways. When we look at cash to 3 to 7 year bonds, not really showing any inflation concerns here. Getting a little bit more concerned when we look at TIPS, which are Treasury inflation protected securities. They adjust for inflation, they adjust for their interest rates. When the market is worried about inflation and interest rates going up, they get into TIPS. When they're not worried about that, this ratio goes down, they get into 3 to 7 year bonds. Well, we've been going back up a little bit here. So there's a little bit of a concern. It's still in a downtrend, and we're not seeing a real big warning sign here. We just want to keep an eye on this. And see a similar pattern here when we look at TIPS to 7 to 10 year bonds. That's further out. This ratio has really been coming back lately, but it's not really breaking out of the range that it's been in. We'll just keep watching this one. We want to keep an eye on the 10-year yield in Japan. If this really breaks to the upside, it was a year ago, August, that we had things going bad in Japan, and then the VIX went to 65, and we had the end of the world days that lasted 2 or 3 days there. The market was really tanking, and everybody was demanding a 1.5% rate cut from the Fed, and it went by pretty quick. Everything was emotional. The financial media was loving that. Well, that was caused by the Japanese 10-year bond going up at that time and getting to a higher level than where it was at before. Now, we're not really concerned about this. We just want to watch this. And if we do see more of an upward move with the 10-year yield in Japan, that could start to cause some problems. And then we're keeping an eye on the 10-year to 3-month yield curve. We're back to normal here, but we've been chopping above and below, being inverted and uninverted along the way. Just watching that. We want to keep an eye on the spread between risky bonds like junk bonds and government bonds. This has been under control for the most part here. And then we had retail sales on Friday, and retail sales, when you look at it by itself, they're doing okay. We're seeing a recent golden cross here, and we're above both of the moving averages, and the RSI is above 50. But when we compare it to the S&P, retail is continuing to underperform. It has been now going back to 2021. To be stronger, we want to see this ratio going up. But by itself, retail's still hanging in there okay. Then we look at some different ratios here. Now, the weighted version of discretionary to staples showing a little bit of improvement here. We want this ratio to go up to be positive. Then we look at an equal weight version of discretionary to staples because Tesla accounts for a huge part of discretionary. Amazon does too. Been coming down a little bit here, but we're still generally going up overall. And generally going up here, when we look at the tech sector to utilities, that's more positive. That's growth outperforming value. And then biotech, which is growth to healthcare, that's tending to go up. Seeing a little bit of weakness here when we look at hotels to utilities. So we'll keep an eye on this. Generally, when all three of these ratios are going up, that's when the market is more positive. When we see things start to roll over, that's just a bit of a warning sign. So that's what we're treating this as right now. Then we look at some main, what we call bellwether industries in the U.S. economy. Semiconductors are doing pretty good here. And home builders, doing okay. Transports, they were doing good, but now they're starting to fall back. Going sideways with retail, but it is in an uptrend overall. Seeing a little bit of an improvement here, but pretty much sideways action when we look at the regional banks. Again, when these are all going up, the market is stronger. And we look at gold to the S&P, we're still below this declining trend line here. Gold has been going sideways as the S&P, for the most part, has been going up, and that's why this ratio is going down. Keeping an eye on oil, we're still in the mid to upper 60s now, and that's more geopolitical. So that's why we keep an eye on this. And we want to keep an eye on the dollar. This is a daily chart where we did bounce all the way back up to the 50-day moving average, and now we're starting to come back down. This is still in a downtrend. And if you saw the weekly chart, we're also in a downtrend with the dollar as well. The stock market likes a weaker dollar, and the dollar going down has been helping stocks to actually go up. Then just keeping an eye on the German DAX, still above its 50-day moving average, still in a pretty solid uptrend. Then we look at a ratio between the S&P and the German DAX. For the most part, this is going up, but it's kind of stalled out as we got more into July. And then U.S. versus international stocks, kind of setting a base here. We're seeing a bit of an improvement, but we want to see this go up because U.S. stocks have not had a leadership role in 2025. You can see started off pretty good, and then this ratio really started coming down. Now we're leveling out. If this ratio goes up, that would mean that U.S. stocks are outperforming international stocks. Then emerging markets showing a bit of an improvement, but not really breaking out above this previous high yet when compared to developed markets. Then momentum stocks, as we've been going up with the S&P, we're seeing the momentum actually going down. Now this is a ratio, and this just means that the S&P is outperforming momentum stocks. So you could actually take this as being more positive. Then inflation expectations, it's going up. Now we're seeing the CRB index in an uptrend across all time frames. Oil's been going up a bit. That's more geopolitical. Some of the inflation concerns, when we look at different maturities of bonds, they're starting to go up a little bit here. And then we see this starting to go up as well. All right. So now CPI came in hotter than expected, but then PPI came in weaker than expected. But CPI is the one that folks really focus on here. If this continues to go up, that could put some pressure on the markets. So thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.